Hey there, everybody, and welcome to Yahoo Finance Live. I'm Dave Briggs, along with Jared Blickery. Let's get you up to speed on Thursday's market action. We will have the latest on SBF in just a moment, but check this out. We get feats of strength tomorrow on my second favorite holiday. That's Festivus. Today, signs of weakness all over the markets. You can see the Dow down nearly 500 points, actually off session lows. The S&P down about 2%, and the big loser of the day, the Nasdaq, down nearly 3%, or about 300 points. Some bad news in the chip sector and more. Jared Blickery now going to take a deeper dive on all of that. Jared, what drove this action, man?
This is reminding me of 2018. It was a big slide into Christmas, and then we had a huge relief rally afterwards. This is going to happen this year. We don't know just yet. But as you said, Dave, the Nasdaq down almost twice what the Dow is, and that's kind of been the story for the year. Now, looking at a year-to-date chart of the Dow, you can see, and let me put this on a year-to-date basis, we are somewhat in the middle of the range. Here is the low of the year, and here is the upper end, and we are somewhat in the middle. Now, you take a look at the Nasdaq only minutes ago, we are on track for the lowest close of the year. In fact, you'd have to go back to last year to find a lower settlement price, but we're not there just yet. We got a lot to talk about here. Want to take a quick look at the bond market because we're getting a mixed picture here. The 5-year T-note yield up 1 basis point, the 10-year T-note yield down 1 basis point, and the 30-year that is down 2. So not a lot happening in the bond market. Kind of unusual to see the stock market acting up in such a big way without any follow through in the bond market. Here's the U.S. dollar index that is elevated just a little bit, but let me show you the carnage with some of our heat maps here. Here's the Nasdaq 100, concentrated selling in NVIDIA down 8%, Tesla down 9%, Amazon down 4%. We're going to talk about all these tickers, but broadly speaking, it is tech that is taking it on the nose here. XLK, that is the tech sector. For the S&P 500, that is down over 3%. So is consumer discretionary. And then energy, the best performing sector of the year. Can't find any love there today either, Dave.
Absolutely brutal. We will dive more into the markets momentarily, but first, let's get you up to speed now on the latest with the FTX criminal charges, as a New York judge has granted former CEO Sam Bankman-Fried bail to the tune of $250 million. Our Alexis Keenan tracking the latest for us. Alexis, what did we learn today?
Yeah, Dave, this is just a monster bail bond amount that was set, $250 million bond set by a magistrate judge. That came at the suggestion of U.S. attorneys who did not contest bail, but they did ask for this high bond amount. And they said in court, according to reporters who were there, that this, they believed, was the highest ever pretrial bond. The judge said that Bankman-Fried would then be asked at a later date to actually enter his plea. So we did not hear that in this hearing, whether he will plead guilty or not guilty to the charges. Now, according to the intercity press that was in the courtroom, the terms of the bail required this. First, Bankman-Fried will be required to be on home detention at his parents' home in Palo Alto. He'll be required to wear an electric monitor to monitor his location. Also, he must surrender his passport, and he must keep his financial transactions to under $1,000 unless he gets more authority to transact in higher amounts. The judge also noted Bankman-Fried's strong ties to his community, said he was a U.S. citizen, and his notoriety, the judge said, would lessen the risk of Bankman-Fried being a flight. Now, in support of his freedom, his own attorneys, they highlighted that Bankman-Fried voluntarily left the Bahamas, waived his right to fight extradition to the United States. They said that should go in his favor. Also, they said, interestingly, at home that he could get exercise as well as mental health and substance abuse treatment. So it'll be interesting to see if he does enter a not guilty plea, if that will come into his defense. Now, this is all, of course, on the heels of an announcement late last night from the Southern District of New York. Federal prosecutors say that 2 of Bankman-Fried's former deputies, Caroline Ellison and also Gary Wang, had entered guilty pleas on multiple criminal charges and also flipped as witnesses for the prosecution. Those 2 executives are charged with similar counts to Bankman-Fried, wire fraud, conspiracy, among other charges. Back to you.
A major day in that trial. Alexis Keenan, thank you so much. Joining us now with more on the case, Nick Ackerman, former assistant U.S. attorney of the Southern District of New York, former assistant special Watergate prosecutor. Good to see you, sir. Want to circle back in a second to Ellison and Wang cooperating, but just your reaction to the $250 million bail set.
Well, that's pretty substantial. But then again, The amount of money that is the subject of this fraud that has been alleged in the indictment is in the billions of dollars. And clearly, this particular defendant had access to lots of money at some point. And the bond is being secured by the home that his parents own in Palo Alto. So that gives him an extra incentive not to flee for fear of wrath from his parents. So I think that, this is probably an appropriate bond under these circumstances and considering the magnitude of the crime that's involved here.
Thank you for being with us here today. I want to ask you about Ellison and Wang and their potential involvement with the prosecution. Anything you can glean at this very early stage that they may have been able to share with authorities that may have helped the case against SBF here?
Oh, I think they are the primary witnesses that led to the indictment here of Bankman-Fried. I mean, they are both insiders. Ellison was the person that was handling the customer money at FTX, and Wang was the person who created the program that allowed them to move money around illegally. So you've got people who are actually living with Bankman-Fried in the Bahamas. They started the company with him, basically. And they really know where all the bodies are buried. They know who's involved. They know who did what, and really are in a position to name names of others who might be involved. And it wouldn't surprise me, and we talked, I think, on the show the last time about whether or not Bankman-Fried's parents might be criminally liable. And certainly they would be in a position to know that, as well as other people who were in the company that might be criminally involved.
Nick, does the speed at which this has all taken place imply that this cooperation deal has been in the works for quite some time? And what's your expectation as far as a plea from Sam Bankman-Fried?
Well, I think, first of all, yes. I mean, this deal with these two cooperating witnesses didn't happen overnight, but it was pretty quick. I mean, it wasn't as though, a lot of time has gone by on this since all of this has hit the papers and everybody knew about what was going on in the bankruptcy court. So it's apparent that the authorities acted extremely quickly here. They went right to the people that were just below Bankman-Fried, the people that really would be able to basically give him up, and they made deals with him. They each of them essentially admitted to a series of crimes, the same thing that Bankman-Fried has been charged with. And they're hoping that through their cooperation, that will mitigate to a great extent their sentence, which means it's not only testifying in the grand jury and providing information, but it also means testifying at a possible trial, which brings us to what is Bankman-Fried going to do. It seems to me, knowing that his two cohorts have pleaded guilty, it's going to be very tough, if not impossible, for him to go to trial on these charges. It seems to me that when you have two insiders that were that close to him, basically laying out the scheme, it is almost virtually impossible to ever think that he could be acquitted by a jury. And that if I were his lawyer, I would basically advise him to cut his losses, take a plea, and make the best possible deal he could so that at least he goes before the court showing some remorse, showing that he's basically taken responsibility for what he did, all of which are mitigating factors that could be used ultimately in the sentence that he receives.
Nick, how much of the trial, of the facts, of everything involved in this case are complicated by the fact that it's involved with crypto, a relatively untested area when it comes to, I guess, over time, just because it's been a rather new area, a rather new asset class? Just wondering, can the existing fraud statutes just easily cover this, or is there something else involved that may slow down the proceedings, that may cause hiccups that you could potentially see because this is, in fact, a rather new asset class, crypto?
Well, it is a new asset class, but it's an old traditional fraud. It's really no different than any other fraud. They essentially lied to the customers, didn't tell them about the fact that their monies, and then the investors of FTX, that the monies there would be going to Alameda, another company, that was a private company owned by Bankman-Fried. It was basically, they took people's money, whether it was the lenders of Alameda, whether it was the customers or the investors, and they essentially moved it around like it was one big slush fund. There is nothing unusual about this fraud. I mean, this is a pretty classic fraud that is perpetrated and has been perpetrated for years. And the fact that it's a new asset class really doesn't make a bit of difference.
All right, we have to leave it there, but thank you again for stopping by here. Nick Ackerman, former Assistant U.S. Attorney, Southern District of New York, also former Assistant Special Watergate Prosecutor. We are just getting started here on Yahoo Finance Live. Coming up, more on the SBF saga. The Wolf of Wall Street himself, Jordan Belfort, joins us. And the major indices take a nosedive after 2 winning sessions. We're going to dig deeper into what changed. And NFL Sunday Ticket is officially heading to YouTube. Find out how it could be a game changer for football fans and the streaming industry after this. Welcome back. Markets stuck in reverse on Christmas Eve, about 50 minutes before the closing bell. Let us bring in our next guest, Brian Levitt, Invesco Global Market Strategist. Brian, great to see you here today. I was going through some tape earlier. I was trying to find a similar situation, and at least in the short term, if you go back a few years to 2018, we had a huge 7-day slide into the Christmas holiday. Very different macro circumstances now. Just wondering what your big picture takeaway is as we head into the holidays here.
It's a different macro picture, but if what you were dealing with in 2018 was also policy uncertainty, we had struggles around what would be with the U.S.-China trade war and concerns that the Federal Reserve had tightened policy too much that year. So there's always something that, every cycle isn't similar, but there's always something that rhymes. And what we're grappling with right now is still policy uncertainty. I mean, quite frankly, we've been dealing with policy uncertainty all year. I suspect it starts to get a lot clearer in 2023 with inflation coming down, but that's the narrative, and that's been the narrative of 2022.
Brian, we had some decent gains yesterday, gave them away and then some today. What do you think is driving this massive downward move ahead of the end of the week?
It's hard to tell what drives it on any given day. We did see some bad earnings reports from some cyclical companies, so that does suggest a slowdown in economic activity. But quite frankly, that's what the central bank is trying to foster, trying to create, and so that's why inflation becomes a problem, because you end up getting the type of policy tightening where the Fed ultimately goes too far and then the economy moves into a recession. Now, what's interesting for investors and what they should contemplate is how much have we already priced in? I mean, you consider a peak to trough decline in the market from January to October of 25%. That's pretty much in line with a mild recession. So maybe we retrace some of it, given the recent gains that we have. Maybe we come back down a little bit. But I suspect that the bottom is in for this cycle. And I believe that as inflation comes down and the Fed pauses, that you'll start to get a much better picture for risk assets.
All right, Brian. So if the bottom is in, what sectors, what styles are you looking at right now? Where do you see opportunities in the early new year?
Well, the first would be risk credit. I mean, the fact that you can get attractive yields in credit, things like high yield bonds, equity-like yields, equity-like return yields, and you do have some interest rate sensitivity in that. You do have some duration in case the economy slows and yields come down. And so, yeah, I mean, we still may have to deal with a recession and defaults will go up, but we think we're being compensated for that. Now, within the equity markets, it really depends on your time horizon. Look, if you're an investor that can't handle another 5 to 10% decline here, then you want to be more defensive. You want to be exposed to lower volatility factor. But if you're like me and you're looking ahead to the next couple of years, you want to be thinking about what recoveries look like. And anytime inflation has peaked and come down over the next couple of years, markets have done very well, with the lone exception being 2008. And so you want to look at cyclical sectors and factors. You want to be more exposed to non-US dollar, emerging markets, smaller cap, value-oriented. That's what tends to do well as a recovery plays out. It's not going to be a straight path, but we will be there over the next couple of years.
All right, Brian, let's save some people the disappointment of making their New Year's resolution, losing weight and stopping drinking. They're not going to hold. So you've got some New Year's resolutions for investors. Give me a couple of your favorites.
Yeah, it's the same as I think I have all the time, which is, first of all, save money. It's so hard for people, but when you look at how Americans spend money, they're wasting, it's estimated 18% of their annual income on things they don't need. It's gym memberships they don't use, gambling, it's wasted energy, it's wasted food, it's credit card interest. And so what I always say is think of every purchase you make in terms of opportunity costs. What else can you be doing with that money? Once it's spent, it can't work for you. So great ways to try and get rid of that. Save first is automate those investments. It's out of sight, out of mind. You pay yourself first and steal your nerves. Time in the market. I mean, this was a year that tested everyone's nerve. It was an everything bear market. But the reality is we've been through challenges like this before, and over time, markets have tended to advance to ever new highs. It's all about having a plan, sticking to it, and staying with it through periods of market volatility.
Sounds like a plan. Brian Levitt, Invesco Global Market Strategist. Merry Christmas to you, friend. Good to have you on.
Thank you.
Coming up, AMC shares falling sharply after the company announced it was raising capital. Stay with us for the details.
Welcome back. YouTube TV won the exclusive rights to stream the NFL Sunday Ticket. The Google subsidiary reportedly paid $1 billion more than the previous rights holder, DirecTV, putting the price tag around $2.5 billion. Here with more on this major deal is Yahoo Finance media reporter Alexandra Canal. Allie, what do we know about this deal?
Jared, a reported $2.5 billion. I mean, that's a really high number to even wrap your brain around. But we know that sports is a highly sought after asset in the streaming wars. And for a company like Alphabet, $2.5 billion really is just a drop in the bucket, which is why we didn't see too much of a stock reaction on the heels of this news. But for those unfamiliar with NFL Sunday Ticket, it makes out-of-market games available to fans. So for example, I run into this all the time living in New York City. I am an Eagles fan. I am also a YouTube TV subscriber. I pay that $64.99 a month fee. But if the Giants and the Jets are playing at the same time as the Eagles, I cannot watch that game. So for me, since I'm already a YouTube TV subscriber, I can, for a price, purchase NFL Sunday Ticket as an add-on. Now, if you are not a YouTube TV subscriber, you can purchase it a la carte. We do not know what the price point will be at this point, but it's safe to say that it's going to be pretty high, especially if YouTube wants this to be a profitable offering. It's worth noting that DirecTV, which as you mentioned was a previous rights holder, did not make money on this offering. So you have to wonder if the goal here is for YouTube to simply add more subscribers. YouTube TV had more than 5 million paying users and trial users as of July. So I do think there's more room to run, and I do think they will add subs. And if you have more subs, you don't need to rely as heavily on those ad dollars, which we know have slowed down amid the economic environment. But again, the big question is, what's the profit potential, especially considering that high price tag?
Yeah, also curious, Allie, about what happens with bars and restaurants. Who's able to secure that deal? The NFL still thinks there's another 200 million out there. How will greater profitability concerns across the entire media sector impact these types of deals?
And that's a big question, because a lot of these media and streaming companies were simply priced out from even attempting to acquire this package. Apple, they were in negotiations, dropped out earlier this week because reportedly there were too many restrictions for the price. Disney, same thing, just couldn't afford it. So it's really these big tech companies that have the money to power these types of deals. And especially considering we're in this period where investors are punishing media companies that can't turn a profit, this puts the pressure on. And if you think about cable operators too, Fox, CBS, when those sports contracts eventually expire, will they be able to outbid big tech? And what could that mean for the future of cable? What could that mean for the future of the streaming wars? So all these companies will be watching very closely to see how this ultimately plays out for YouTube TV, since sports, no matter how pricey or expensive it may be, is the new shiny object in streaming.
Yeah, YouTube just became the new cable, and cable starting that slow bleed out, it would appear.
Yeah.
Sorry for the graphic imagery there. Allie Canal, good to see you. Thanks so much. Here with more on the Google NFL deal and the latest on AMC Entertainment, Michael Pachter, Wedbush Managing Director, Equity Research. Michael, good to see you. You say sports never made sense for the competitors of this deal, Amazon nor Netflix. Why does a $2 billion deal per year make sense for Google?
Well, YouTube TV is not on demand. It's broadcast. So you're getting content by appointment when it's on, as opposed to Netflix, Amazon Prime, where you just pick what you want to watch and it's available whenever you want to watch it. Live sports is probably the standout content that you actually care about seeing it when it happens. You can maybe wait until the next day to watch American Idol if you stay away from people and they don't tell you who got booted off, or any of the reality TV shows. But sports, you kind of can't get away from the fact that your favorite team won or lost. So you want to watch it live. YouTube is in the business of selling subscriptions to live broadcast. And, as Alexandra said, $64.99. I don't think they make a penny at that level, but they're trying. 5 million subscribers is just not enough. Even if all 5 million subscribers pay them that $400 a year for DirecTV, that's what DirecTV charges for a Sunday Ticket, they're going to barely cover their costs, probably not. So they're not making money on this. This is a loss leader, but they're going to get somebody like me. I'm a DirecTV subscriber, and I pay something like $250 a month for DirecTV. I'm going to consider YouTube TV. So they might win me over. They might get 10 million new subscribers. And I think they can be smart about how they carve up the content. So as you guys mentioned, bars, maybe sell these things on a per game, per view basis to bars for $100 a game or $200 a game. If the local bar has your favorite team, you may go in there and buy several beers, and you and 20 friends. So I think there's opportunity for them to actually exploit this better than DirecTV has, because of the nature of YouTube TV being over the top. Anybody with an internet connection can get it. So ultimately, it probably does pay off.
All right, let's switch now to AMC. Shares plunging today after the company announced a new $110 million capital raise and a proposed reverse stock split that will require shareholder approval. What are your thoughts on this latest announcement? Does it really change the future for AMC, which has been relatively circling the drain?
I have to really compliment the management at AMC for keeping this ship afloat this long. I mean, I quipped this a couple of years ago, but they're navigating the Titanic through the iceberg field, and they've managed not to hit one and not to sink the ship. So everything they do is to stay afloat. And this latest share offering of APE shares is intended to pay down some more debt. They still don't have enough EBITDA to cover their interest expense. We have them breaking even-ish next year. The offering, there's been a structural mismatch in the APE shares, their preferred AMC shares, and the common AMC shares. They should be valued about the same. The preferred just have slightly better liquidation rights, and they've been trading at a discount, the APE shares, because investors have seen this coming, that they could continue to issue preferred stock, and that's what they're doing today. And I think that people got spooked. Oh, they're going to dilute my APE shares. Well, they actually dilute both when they issue one, because they have the same voting rights and the same essential value. The reason APE shares are trading up is that AMC announced that they're going to try to convert the preferred shares into common, which means they are the same security if shareholders approve. So APE went up because the gap between the common and the preferred is closing, and AMC went down. They aren't yet at parity, but the plan, I think, for the company is they'll be at parity. So I would add the two together. This 468 and 129, add them together and divide by 2, and that's where they should trade. Anybody who wants to exploit this, long APE and short AMC, and as that gap narrows, you should make money if it keeps going down. Reason it's going to keep going down is they don't cover their debt. They have some more equity to issue to get out of debt. They have a lot more equity to issue.
I appreciate the pairs trade recommendation. Make a note of that. I want to show you two different tweets here, two different takes. I really appreciate the way you just broke that down, the dual share class, and exactly what it means and why they're differentiated. Dave Portnoy was tweeting from over at Barstool Sports earlier. Here's my take. So APE is up 90%, AMC down 15%. To me, they're the same company, except AMC is real and APE is sort of made up meme stock for superfans. So meme stock, which isn't real world, is way up and company stock is way down. They're hoping meme stock saves the real world stock. Now, as you just outlined, this is not what's happening, and this is not to pick on Dave, by the way, because this is complicated stuff. But I want to highlight another tweet. This is by Adam Aron. This is the CEO of the company saying, also, a company as distinguished as AMC shouldn't let Wall Streeters wishing us harm drive us to being a, quote, penny stock. So in the shareholder vote, you can consider a 1-to-10 reverse split, simple arithmetic. If approved, the share count goes down, so share price goes up. You think Adam Aron is playing to the naivete of the investor class here, maybe just a little bit, maybe counting on, I guess, maybe not as much investor education as there should be in this space?
Yeah, he is. Portnoy is right that that disparity is recovering because they really are the same thing. The APE stock is a meme stock only because he named it APE, that he tried to play to the apes, but it actually is just a dilutive share. It just increase the number of shares. Adam is basically saying if you take 10 pieces of pizza and glue them back together, you somehow have something better. If you had 10 pieces and now you glue them all together and it's one pie, it's better. I don't understand that at all. It's the same calorie count, and that's exactly what's going to happen when he does his 10-for-1 reverse split. So I really don't understand what he's trying to say. Anybody who falls for that is not very smart. Portnoy is really smart. So I would, and Adam Aron is really smart too. Anybody who believes Adam Aron is a dummy, and anybody who follows Portnoy is probably pretty smart.
All right. Well, I appreciate the candid words there. Thank you for that. Michael Pachter, Wedbush Managing Director of Equity Research. All right, coming up, CarMax shares hitting their lowest point since the early days of the pandemic. Find out what investors don't like about the auto retailer's earnings report when we come back.
All right, time now for Triple Play. Three stocks we're watching in the final 30 minutes of trading. CarMax, Under Armour, and Micron. Josh Schaefer here to play ball with us. I start with CarMax. Shares in reverse today, big time, after the company said it was pausing hiring, halting share buybacks, and cutting expenses after an 86% drop in third quarter profit. You can see down there about 3.5%. Shares at their lowest level since April 2020. You know what that is. The early days of COVID. Said Evercore ISI analyst Michael Montani, quote, CarMax is battling a used vehicle recession. Nothing less. CarMax reported retail and wholesale sales down 28% in Q3. It also bought 40% fewer cars in the quarter. Shares down, as I said, 3.5%, down more than 50% year to date. Also in the sector, Carvana managed to fall even further and is now down 98% this year, Josh.
Yeah, Dave, I mean, it's what we've heard from car analysts that we've had on the show over the past couple of weeks, too, right? The used car demand is just not coming back. I mean, you remember Cox Automotive chief's economist was telling us that it's a lethal combination to have recession coming and also rising interest rates. Well, those rising interest rates aren't going anywhere. So I don't know how this story turns around, at least in the near term, right? But
Could be a couple years. Yeah,
Exactly.
I mean, at least a year.
It'll be interesting to see. My pick today is Under Armour. Shares sliding today, off about 3 or 4% after the company named a new CEO. Current Marriott International President Stephanie Leinartz will now be Under Armour's new chief executive. Leinartz has been at Marriott for over 25 years and comes to Under Armour with little retail experience. Wall Street analysts a bit mixed on the reaction there with the stock. Wells Fargo lowering its price target from $20 to $14. Bard and Telsey upping their targets slightly to $10 and $11 respectively. But really I want to focus on what one analyst had to say here, Dave. David Schwartz at Morningstar said he has fair value on shares at $15.50, and he likes the move because it reminds him of what Nike did with CEO John Donahoe in 2020. And that's because of the new CEO here for Under Armour's experience in digital sales and digital marketing. That's an area Nike grew a ton over the last 2 years, somewhere where Under Armour's sort of been lagging. I think it's going to be interesting to see what happens with that.
Yeah, there's a lot of ways they are trailing Nike, needless to say. But what we learned in this most recent quarterly report from Nike is the real asset probably is the thing they're executing the best is digitally. They know exactly when, where, and why you're buying your shoes, and that is a huge advantage over competitors. Also, like a couple competitors in naming a female CEO, Dick's and Foot Locker, also in that space, long dominated by male CEOs. That's nice to see as well.
I'll tell you what, you want to look at the digital divide. I got a chart looking at us on the Wi-Fi Interactive, and this goes back to the 2000s, since the IPO. This is UAA in its heyday here, and this is trying to struggle with the digital divide. It's basically been in a sideways trading range for the last 5 years, now sits at the lower end, so pretty bleak technical picture there. A turnaround strategy would be very welcome. Now, my triple play is Micron. The chip maker reported a surprise adjusted profit of 4 cents per share in the first quarter earnings, but came up short on adjusted revenue and also turned in a second quarter forecast a bit light versus estimates, leading some Wall Street analysts to question when the highly cyclical memory industry will finally trough. Piper Sandler sees the bottom around the middle of next year and has an underweight rating on Micron with a price target of $45. And guys, Dave, the chip sector has been under pressure all week here. I'm looking at the Wi-Fi Interactive. This is today. Let me just show you what's happened over the last 4 days and sort by performance here. You can see a lot of carnage. Lam Research down 8%, NVIDIA down 7.5%, Dave.
Interesting to see competitors down more than Micron on the same bit of news. What do you make of that?
Well, this is a 4-day look, but if we look at today's
solely.
if we look at some of the, like Applied Materials.
What surprised me?
Applied Materials, let's see where they are. Yeah, they're down 8%. They're kind of, they track the results of Micron because they're very cyclical.
Down 6. Yeah, NVIDIA down 7.
Some of the inputs into the fabricators and NVIDIA, which is only a planner, they don't even own fabs. They're just more highly leveraged. So you take a stock that has a lower beta, they surprise to the downside. Those higher beta stocks, they're actually going to have a worse performance, Dave.
Brilliant stuff, man. That's why you are
Sometimes
Dr. J.
He's the doctor.
I mean, that's why
sometimes I just make it up, but I didn't just now.
No, you didn't. You stuck the landing. Thanks for playing, Josh. Coming up, 2022 has been a wild year for Wall Street. Hear what some of the biggest players on Wall Street had to say next.
Welcome back. From the COVID-19 pandemic to record inflation, 2022 has been a roller coaster ride for markets, and as the world navigated these hurdles and more, many of its major economic players weighed in. Now, joining us to discuss some of the highlights is Avondale Asset Management founder and the transcript editor, Scott Krisiloff. So, Scott, let me begin with Fed Chair Powell. Now, he had some interesting comments at last year's Jackson Hole conference, which was actually in August of this year. Let's listen to that real quick.
The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we're confident the job is done.
Now, I like this one in particular because Keeping at It is actually the title of a book by Paul Volcker, who's also a hero, I would say, of Powell's. He's mentioned him at various times this year. Just wondering how your service, and maybe you can just give us a brief overview of that as well, how it fits in and your analysis of what Powell is trying to say here.
Yeah. I mean, I think as you think through the top quotes of 2022 and the real themes of 2022 as we're looking back through the year, the biggest theme for capital markets was the actions of the Federal Reserve in tightening interest rates and tightening financial conditions. And that really happened in a few stages. I think if you're thinking about the beginning of the year, we were actually still at zero. The Fed didn't raise rates in their January meeting, started to raise in March, and then started to get really aggressive in August. So if you're thinking about, again, 2022, August was really a turning point for the year when the Fed got very aggressive, and Jerome Powell sort of signaled that for the first time at Jackson Hole, the conference at Jackson Hole. So,
one might argue the financial soundbite of the year was from who else? J.P. Morgan Chase CEO Jamie Dimon at a conference in June. Let's listen.
It's a hurricane. Right now it's kind of sunny. Things are doing fine. Everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy or Sandy or Andrew or something like that. And you better brace yourself.
I would be willing to bet the word hurricane has been used in every subsequent interview for Jamie Dimon since then, and he's clearly pausing, trying not to use such descriptive terminology. How influential, how much did that set the tone for the months ahead?
Yeah, I mean, I think it was really important. And I think that it's the same thing that all of us have been dealing with throughout this year as we've been following capital markets and trying to prepare for a potential hurricane. I think Jeff Bezos later in the year talked about battening down the hatches, which would be a similar sort of storm metaphor, I think. But the interesting thing, especially when you go back to Jamie Dimon saying that, is that there's two dynamics there. There's a storm that's forming on the horizon, but hasn't quite hit. And I think throughout this year, one of the themes actually, in addition to this, was just the resilience of the consumer. The consumer continued to spend despite the Fed's tightening and capital markets being soft. And it's only really been towards the end of the year that we're starting to see some of the softening happen. So a storm on the horizon, Jamie Dimon talking about it being still sunny as far as he was sitting and as far as all of us were seeing, that storm is really coming forward, not quite here yet, though.
We want to stick with big banks here and just think about the new year. Earlier this month, Wells Fargo CEO Charles Scharf says we are in the midst of a slowdown and people are spending less. Here's what he had to say.
There is a slowdown happening. There's no question about it. When you watch CNBC and Bloomberg and read the newspapers, it can be a little bit confusing because the slowdown is across industries. When we look at our own consumer spend information and we talk to the companies that we bank, there's some that are doing quite well and there's some that are struggling more. Net, the growth is shrinking that we've seen in card, albeit there's still growth. Debit card spend is about flat, with transactions being down a little bit, offset by inflation.
So some comments about the consumer there. What are your takeaways?
Yeah, I think, again, as we were looking at the quotes of 2022, this one stood out as really important for me because it was recent. This was actually at the beginning of this month. This was Wells Fargo's CEO talking about a softening actually happening, confirming a softening. And as I mentioned with the Jamie Dimon quote, throughout the year, we had seen that bank CEOs and credit card companies, especially, who were seeing the full view of consumer spending, had not seen really much weakness coming forth. But really in these last few weeks, Black Friday sales were only up about 3% from the year before, and then consumers may be starting to pull back. So if consumers are softening, that means that the entire economy may be starting to slow. Maybe we are getting the recession that a lot of us have been waiting for this year. And that would have implications for Federal Reserve policy and capital markets for next year. So as we're thinking about what happens in 2023, this is a nice little bookend for 2022 as kind of a ... Let's see what happens.
All right, Scott, batten down the hatches. Prepare for hurricane. Don't know how many I got left. Good to see you. Merry Christmas to you. Ahead, TikTok reportedly ramps up its efforts to show the U.S. government that users' personal data is indeed safe. But new revelations are raising new questions about the company's data gathering practices. "19 U.S. states have at least partially banned TikTok on government devices and computers, and the Senate has passed legislation to do the same. TikTok, meanwhile, doing their part to assure the U.S. government the data is safe from the Chinese Communist Party. Tech editor Dan Howley here with the very latest from TikTok. How are these efforts going?
Not great. So basically, the government and TikTok have been in these negotiations over how TikTok can assure the government that user data for U.S. citizens is secure from being accessed from folks in China. They've been offering these different solutions, working with Oracle, having U.S. data only accessible in the U.S. through Oracle's cloud services, having Oracle go through the code itself to see if there's any kind of backdoors. But really, it hasn't helped at this point. I don't think that there's any real way that they'll be able to assuage concerns from the U.S. Intelligence agencies. The FBI has said it's a problem. The CIA has said it's a problem. Those are really the agencies that would recognize, especially, the CIA when it comes to issues like this. And, I think it's interesting to see, there's kind of this strange disconnect between Twitter's user base and then the people that are trying to,
TikTok,
control
you mean?
it. Yes, yeah. Where there's the users who don't seem to really recognize what's going on. You don't really talk. It's not talked about.
They're not concerned.
Right. And then there's the legislators, the security apparatus that are saying, look, this is a problem that needs to be addressed. It not going on government devices, I mean, that makes sense. I believe we've done that in a number of states.
Seems like a no-brainer. Yeah.
Right. The military, you're not allowed to have TikTok on there. You know, it seems as though it continues to go more and more against TikTok. Now, don't forget, the Trump administration tried to ban the app outright. And, you know, they were just bogged down in legal fights about it and ended up losing. There was supposed to be an order that it would be banned. Joe Biden lifted it. The idea was, look, we'll try to get some kind of resolution here. But it doesn't seem like it's getting there anytime soon.
Well, let me ask you about ByteDance, the parent's company. A new report in the New York Times earlier today saying that ByteDance employees had, quote, inappropriately obtained data on TikTok users, including that of two reporters. Dan, what can you tell us about that?
Yeah, so this is from the Times, and then on Forbes, one of the writers who was a former BuzzFeed writer moved over to Forbes and wrote about this issue on Forbes itself today, basically discussing how, you know, there were leaks going on. Journalists had gotten a hold of some data about the operation to try to get U.S. data in the leave U.S. data in the U.S. Rather. They ended up having ByteDance had this team that was going in to try to see where the leaks were coming from, what was happening. Apparently, members of this team then went in, got information, including the IP addresses and other information from these two reporters and people associated with them. This is exactly what ByteDance doesn't want to see happen at this point. Their heads of the company are basically saying, look, this was not something we wanted to happen. The relevant people who were involved in this have been fired or resigned. But I don't know how much this is going to, you know, really help saying that when we already have the government and the intelligence agency saying that this is a problematic app. And, you know, really the issue comes down to two things. One is the devices that it's installed on. So, you know, you could tell people to not install an app all you want unless there's some kind of software on their phones preventing them from doing so. Yep. Someone's going to say, it's just TikTok. It's not that big of a deal. The other issue, so they can gather information on potential government targets. The other issue is influence campaigns. And, you know, is China going to be able to say, we're not going to have any information on anything negative about China, but we'll have information on things that are negative to the U.S. And then, you know, the potential to have data on younger users, and then they move into positions of power, and then being able to use that against them. So there's a number of problems here. I don't know how it will be resolved, though.
One of the central questions of 2023, quite frankly, in the entire tech industry.
Yep. All right, Dan Howley, thank you for that. Coming up, we're counting down to the closing bell on Wall Street. Stick with us on Yahoo Finance Live. We are minutes away from the closing bell on Wall Street, and let's break down the market action here. Nasdaq down 2%, having its worst day in a while, although it's not quite the disaster it was earlier in the day. But I want to show you what's happening in some of the sectors. And for that, everything in the red, all S&P 500 sectors in the red. XLY, that's consumer discretionary, that is down the worst. That's down 2.64%. XLK is tech, XLE is energy. The best performing sector of the year, up 50%, is down today. So interesting mix to see what is not working. Here is our leader in sentiment index, only biotech, that's IBB, that ETF up in the green there. So is LQD, that's a bond ETF. But look at SOX, that is the chip ETF, that's down 4%, also having a terrible day. Meme stocks, cannabis, disruption, that would be ARC, as well as solar stocks. So pretty broad mix there. The baby perhaps getting thrown out with the bathwater. We've been talking about meme stocks, GameStop popping up on our list today. And here's a look at the intraday. There we go. And AMC has been quite the story, because if we sort by performance on our meme stock board, we're going to see Ape Shares, that's a preferred class, that is up 73%, while the other one, AMC, has been down most of the day. Not seeing it right here, but you're going to have to trust me. Now, there we go, down about 7.5%. Now, checking in on the travel sector, haven't really touched this much today, but you can see the cruise lines after Carnival reporting disappointing earnings, that is down 7%. Royal Caribbean down about 4.5%. Avis Budget Group down 7%. Airlines getting hit as well. So more of that baby and the bathwater look there. Now, financials not doing as poorly as everything else. We got a little bit of green, but JP Morgan down about 1%. Wells Fargo also down 1%. Here's where it starts getting ugly. When we start looking at the disruption stocks, well, Roblox down about 6%. Shopify down 4%. A few areas of green here. CRISPR Therapeutics, that's up 1%. Healthcare, not as bad as everything else today. But here's where the real carnage is happening. And this would be in chip stocks. We were just talking about the Micron earnings. Well, guess what? AMD is down 5%, NVIDIA down 7%. And if you want to see something ugly, here's the Nasdaq 100, where we find Tesla. Tesla, the mother of the mega caps, down 9%. It is at a multi-year low. And just check out the slide that we've seen. We got a few seconds left here. Here is a 2-month chart. Going to put some candlesticks up there. And it has been a steady slog down ever since it broke those November lows here. The thinking is, well, I guess you can sell into the Christmas rally. By the way, the Santa Claus rally officially begins tomorrow. And on that note, we're going to wrap up with the EV space here. Again, we talked about Tesla, but didn't get to Lucid Motors. That's down 4%. Ford also down 4%. GM down 6.5%. And here is your closing bell on Christmas Eve here on Wall Street.
All right, there's your closing bell on what I like to call Festivus Eve, Jared.
Okay.
I don't know if you celebrate Festivus and the feats of strength and the... No?
Yes.
Okay,
Well,
apparently
maybe.
not a Seinfeld fan. But it was ugly today. As I said earlier, this is signs of weakness as opposed to feats of strength. Brutal day for the markets, 350-point loss for the Dow. The Nasdaq drops 1.4%, and the big loser, tech-heavy Nasdaq down 2+%, 233 points. Doesn't look like Santa's coming to town, does it? For a closer look at the broader markets, let's bring in Sam Burns, Mill Street research strategist. I guess the bomb cyclone that is hitting this country in terms of the weather hit Wall Street today. Why, Sam?
Well, I think people are getting nervous looking what the Fed's doing relative to what they think the economy is going to be doing next year. And it's also, of course, holiday trading, so it takes less activity to move the markets around. I think you're seeing thin trading plus some nervousness about what's going to happen with the Fed next year starting to make people nervous now.
Well, let's stick with the Fed next year. We got past that last meeting, and I think investors just want to wipe 2022 off the books. But looking ahead, the Fed has its work cut out for it. There's a huge disconnect between what the Fed is expecting to do next year, as it is broadcast in its statement of economic projections, and then what the market thinks the Fed is going to do. Market's already pricing in rate cuts for the back half of the year, and in the meantime, the Fed is still hiking. Where do you see this falling down next year?
Yeah, that's right. It's an unusually wide disconnect between the market, what the treasuries are saying, and what the Fed is saying it's going to do. And that's why the yield curve is so inverted. The treasury market is clearly yelling at the Fed, telling it not to hike rates anymore. But the Fed is looking at kind of the more backward-looking data, the year-on-year change in the CPI and some of the labor market data that's probably not the most sensitive things to look at. And they're staying with the rate hike story, at least for now. I suspect we'll get one more rate hike in February. And then after that, things may have slowed down enough for them to pause. I think there's definitely signs of slowing already in the data, but it hasn't come through everywhere, certainly not in the labor market data yet. So I think that's what they're focused on. I think that's why they're staying with their story right now. They don't want to look bad. But I think the Treasury market is looking more ahead at more of the forward-looking data and seeing a slowdown coming next year, and also looking at earnings estimates falling and some other measures that show that things don't look very strong for next year. So inflation pressure should be much less.
Wow. So you think no hike in March, is that then the catalyst for a rebound?
Potentially. I think as the market gets closer to what looks like the end of the Fed tightening cycle, there should be some further recovery in equities. I'm starting to see better signs in my indicators for the equity market, just because everyone has been so pessimistic and so negative for quite a while, certainly through end of October, really. There was extreme pessimism, and now it's gotten a little bit better, but it's still very choppy. People are still very nervous. And I think that's kind of an environment where any kind of upside surprise or less bad news would be enough to lift stocks a bit more.
You mentioned some of the data a little bit ago, and we got a data dump today. We get another one tomorrow. In the mix is leading indicators. It's not one of the indicators, or it's not one of the economic reports that gets talked about a lot in the media, but it's been very prescient forecasting all of the recessions back to 1967. If you look at the year-over-year numbers, when they go negative for 2 months in a row, and this happened in August, by the way, of this year, you tend to get a recession 7 months later. So based on that timeline, we could see a recession as soon as March, or maybe, I guess, on average next March. Just wondering how that lines up with some of the other data you're looking at, or maybe your other macro look.
No, that's right. The leading indicators have really turned steadily downward. And I think that's part of the reason why, the bond market is pricing in lower rates next year, is the assumption that those leading indicators are telling you that there won't be any need for rate hikes, and might even be needed for rate cuts next year. Now, the gap or the disconnect really comes with the coincident indicators, which also come out with leading indicators and get even less press. But they kind of tell you what's happening right now, and the leading indicators are supposed to be the forecasting type of indicators. And there's an unusually wide gap there, where the coincident indicators are still rising. They're still showing growth, but the leading indicators are very negative. And that's unusual to see this wide of a gap. And the leading indicators, certainly do have a good track record overall, but their lead times can vary depending on the cycle. Sometimes they're much more, coincident, and then the recession comes very quickly. And other times it takes, a year or more for the real recession to show up. So I think there's a lot of uncertainty about when this will happen, and if so, how bad it will be. And how sensitive the market is, or the economy really is, to the Fed and interest rate hikes now, as compared to, say, the 2005, 6, 7 period, when there was a lot more leverage in the system, and therefore a lot more risk when the Fed was raising rates.
Mm-hmm. David Tepper raised a few eyebrows this morning, saying he is short on equities next year, short on bonds. You say look international markets, specifically where and why?
Yeah, a lot of the indicators that I look at look better outside the U.S. than in the U.S., and specifically Europe is one of my favorite areas, which is very unusual in the sense that most people are very negative on Europe economically. The economic sentiment, most people are expecting recession. They're certainly seeing a lot of energy crisis there, thanks to the Russia situation. And so it's unusual to see the fact that earnings estimates are actually holding up better in Europe than they are in the U.S. And some of that is related to just the composition of Europe. It doesn't have as much of the big cap tech and tech-related names like Tesla or Amazon or Apple, or some of those names that have been under pressure here lately. They just don't have as much weight in those areas. So they're less exposed to the sources of weakness that we're seeing right now, and even today in the Nasdaq, which is leading the way down. So what had helped the U.S. for a long time was the big tech weighting, the growth stocks. Those are the ones that have been under pressure recently. Those are not don't have as much weight in the indices in Europe, and they're actually holding up better. So and if you think the dollar is going to continue to weaken, or at least stay stable relative to, say, the euro or the pound, then you've got a tailwind for U.S.-based investors to hold non-dollar assets.
Yep, we're waiting for that next directional signal from the dollar. It's got to leave it right there. Sam Burns, thank you for stopping by. Coming up, we'll break down the case against Sam Bankman-Fried with the lawyer who used to be the head of SDNY's complex frauds and cybercrime unit. Stay with us.
All right, let's take a deep dive on the FTX case. We're joined now by the former head of cyber for the SDNY, Ian McGinley, prosecuted the first large-scale crypto case for the federal government, now a partner at Aiken Gump. I have it on good authority that you don't like Esquire, that you like the legendary Ian McGinley. That's what they say. Well, let's start with this latest development. Let's start with this latest development and the plea deal, specifically Carolyn Ellison and Gary Wang. How significant is that for the case?
Well, that is a huge, huge development. I mean, if you've been following the case, you know that recently Sam Bankman-Fried has been out there giving speeches, speaking to media, and he's essentially said, look, there may have been mistakes, but I didn't know. I didn't know anything was going wrong. I didn't know that we were using customer funds and sending it to Alameda. Now you have two of his business associates who have pled guilty. They pled guilty to conspiracy charges, so presumably they are going to point the finger at Sam Bankman-Fried. And it gives prosecutors a real insight into what was going on, because the case starts out initially with documents and text messages, but now that they're cooperating, you have an insider view into what was going on, so it's a huge development.
Yeah, it's really interesting. How long do you sense that plea deal, that cooperation had been in the works? Because this has moved at lightning speed. Oftentimes these take months, if not years, to get to this point.
I mean, this is just incredible work by SDNY, the SEC, and CFTC in terms of speed. I mean, Sam Bankman-Fried was charged in about a month. These Ellison and Wang signed cooperation agreements. Before those agreements are signed, it's a very long process typically. Typically what happens before you enter into a cooperation agreement is you meet with the prosecutors multiple times. They check what you've said against other evidence they have to make sure you're telling the truth. Because the idea is when you sign a cooperation agreement, the government is vouching for you. They're saying you're a witness I can put on the stand. And for them to enter into an agreement, they need to have certain indicia that you're telling the truth. And that usually takes quite a while, so that's impressive.
You mentioned the media tour that SBF went on, interviews everywhere. What do you glean from those in terms of what a likely defense looks like?
I don't know at this stage. It's hard to tell.
Is there any defense?
There are still allegations, and we will see. It is interesting that he waived extradition. That's not typical if you're going to mount a vigorous defense. His lawyer down in the Bahamas said that he wanted to make this right. So there is a world in which maybe this is resolved short of trial, but we'll see.
What do you sense in terms of a likely sentence here, if he is found guilty?
It's very hard to tell, right? Because that comes down to a lot of things at sentencing. The prosecutors go before the judge, defense counsel goes before the judge. The case has been compared by a lot of people to the Bernie Madoff case.
Sure.
Bernie Madoff was sentenced to 150 years. By some estimates, this fraud is just as big, if not bigger. So we'll see. But there's a likelihood of some
decades in prison,
some substantial jail time here.
Is this old-fashioned embezzlement, as we heard of the congressional hearing? What does crypto have to do with this crime, if anything?
Well, it is in certain ways, and what you're referring to is John Ray, who now runs FTX post-bankruptcy, said this is basically straight-up embezzlement, and that seems right. The idea was that Sam Bankman-Fried promised investors one thing and did another with their money. That is the oldest, fraud in the book. That's wire fraud 101. What it has to do with crypto? I think crypto has gotten very popular. Crypto is the vehicle for a fraud like this. Because it's so popular, there's so much money there. There's so many cults of personality. So it's part crypto, but it's part just old school fraud.
And you wrote that wire fraud is the most powerful law in crypto. Why is that?
For this reason, there's been debates for this whole year about is crypto a security?
Right.
Is it a commodity? Is it something else? Do we need new legislation? And in looking at the terrain and following a lot of what the media was reporting, it looked like it's just straight wire fraud, that what's being reported, really. And wire fraud is lying to someone about what you're going to do with their money. And so if prosecutors have that at their disposal, and they've had wire fraud at their disposal for centuries now, I figured they're going to use it, and they did.
What is the involvement of the SEC and the CFTC here?
So they bring, it's a good question, they bring what are known as parallel actions along with the DOJ. Now, there's certain differences in their actions from DOJ. They don't have a wire fraud statute, which is quite interesting. So in the SEC complaint that came out last night, it was interesting because they allege that FTT, the utility token on FTX, is a security. And that is a big moment in crypto because there is a debate about whether those utility tokens are securities. The CFTC said the Ether and Bitcoin that was being traded is a commodity. So that's their hook into the case.
If there's a guilty plea here, why would the DOJ have any reason to make a deal with Sam Bankman-Fried when they have the goods and two cooperating witnesses? And is there any sense that they want a trial? They want daylight shined on this crime to stop further crimes?
Yeah, I mean, there might not be a plea deal, so to speak. The way it usually works, especially in the SDNY, there is no kind of bargaining deal for someone. They get leniency if they cooperate, like Ellison and Wang are doing now. And the way you cooperate is usually you help prosecutors build a case against someone else. And you put your finger on the issue here for Sam Bankman-Fried. He is the head of FTX. He is the top guy. So I don't know who he could cooperate against.
Beyond this trial, do you expect a lot more similar federal charges in the crypto and NFT space, and why?
I think that's a fair bet. I mean, a few data points, right? You have the media and crypto Twitter and a lot of sources pointing out all kinds of fraud in the space. So there's certainly a lot out there in terms of allegations. And then you have the resources to back it up. DOJ now has a crypto prosecutor in every office across the nation focused on crypto. And if that's not a wake-up call for people, the SEC increased its number of crypto-focused attorneys by 50%. And they've said that they're going to focus on all types of potential crimes and areas, including NFTs, stablecoins. So I think this is the beginning, not only of more crypto enforcement, but if you listen to the statements of the U.S. Attorney, Damian Williams, he said, I came out the first day, I told you there's going to be an announcement and there'll be more. Last night he came out and said, I'll be coming out again. So I would stay tuned here.
Well, you helped write the instruction manual for the SDNY, so it's good advice, good thoughts. Ian McGinley, great to have you here. Thank you. Jared?
Thank you. All right, now we want to bring in Sid Powell. He is the CEO and co-founder of Maple Finance. Sid, thank you for being with us here today. We've been talking to former prosecutors today. We're just listening to Ian McGinley talk. I'm just wondering, you're inside the industry for working for a DeFi organization. What's your view of the situation right now?
Yeah, it's a very good question. I think what we've seen inside the space for those of us who are focused on building, particularly in DeFi, is bearish sentiment is abounding. So there's certainly heightened concerns about counterparty risk. This is not unique. This is impacting people across funds as well as projects and startups. A lot of people are sitting in cash, but there is a general sentiment that it does prove out and highlight some of the differences between CeFi and DeFi. So there are some silver linings to what has happened, particularly for those working in the DeFi space.
Well, let's get into some of those silver linings, please.
Yeah, for sure. So I think one of the aspects that was really a standout here was the lack of transparency that happened in the CeFi space, and in particular in the FTX case. So we just heard a lawyer talking about how this was a straight case of basic embezzlement. And what has been highlighted in the contrast between CeFi and DeFi is that transparency is extremely important, as is one of the key benefits of DeFi being non-custodial holding of funds in smart contracts. So a user always has control and custody of their funds. And I think that's something that people are paying more attention to now as they focus on these issues of counterparty risk. And we've seen more institutional focus on these types of products now and a renewed interest in DeFi as a result of this.
Let me ask you, the way the regulatory hammer has come down in the U.S. with all the attention now on SBF, and with my view is, and I was an early cheerleader of DeFi, but it looks like because of the regulations that have come down in the U.S., it's either going to be a game of regulatory arbitrage or nobody's going to be playing the game. Where does DeFi go from here?
I think that's a really good question, because for the longest time, there was a view that DeFi sits outside regulation. But what you're seeing is that there are a number of teams who are trying to offer products and features of their products that are going to be regulatory compliant. You've seen the very first versions of DeFi generally set outside of things like KYC. But what you've now seen is there are a number of what you call permissioned offerings, where projects and teams are looking to offer something that is compatible with AML, KYC, regulation and laws, and that would allow institutions to participate in this space. So I think you'll continue to see this kind of bifurcation where you have, call it the original DeFi that is permissionless, and then you have the new form of DeFi, which is catering to institutions who do want to participate and do want to take advantage of the important infrastructure and rails that are being built in this space now.
While I have you here, we got time for one more. Binance, the biggest, the elephant in the room here, the biggest man or the biggest exchange standing, CZ, has faced a barrage of interest in whether or not Binance can, in fact, hold up during all these customer withdrawals. We've seen their auditor withdraw the proof of reserves work. I'm just wondering, what does this mean for the industry, for crypto as a whole, and then Binance in particular? Does Binance go in the end?
I definitely couldn't make a call on whether Binance goes in the end, but I will say that anything that is a move towards more transparency is important for the space. I think people are pricing in the fact that Binance doesn't have audited financials, and there isn't as much transparency as you would say that there is for someone like Coinbase, who has, of course, public board of directors, audited financials. And so, us sitting in the lending space, those things are immeasurably important these days as everyone is focused on counterparty risk. Binance, though, is a systemic risk in that if something were to happen, it would have shockwaves throughout the space, which would be, as large as anything that happened with FTX. But I think at this stage, from what we've seen, they've been able to process redemptions and withdrawals okay. And so I think, whilst people are being cautious, that's generally being seen as a positive sign by the market.
All right, we got to leave it there, but really appreciate your insights into all of this, Sid Powell. Coming up, former President Trump's tax returns are providing new insight into how he lives a luxury life despite losing a lot of money. We're going to tell you how, up next.
The federal government's $1.7 trillion omnibus spending bill has been passed by the Senate. It was 4,500 plus pages, and senior columnist Rick Newman has tons of time on his hands. So he read every single bit and has the details for us. Rick, what's in it?
Yeah, I'm going to be publishing a 15,000-word Yahoo Finance article on everything there. Everybody wants that. This basically ended up going as expected. We had a little hiccup over this immigration provision, which ended up not being part of the bill. That did not derail the bill. But this went about as expected this week. So out of that $1.7 trillion, $858 billion for defense. We're soon going to have Pentagon budgets of $1 trillion or more. In addition to that, another $45 billion in military and civil aid to Ukraine. That's really important. Congress actually provided more for Ukraine than President Biden asked for. He only asked for $38 billion. So they gave more, and that will last through much of next year. And the rest of the money just basically runs the government. There are a couple things not in there. They did not deal with the debt ceiling, which means we could have a political showdown over raising the federal borrowing limit next year. Also, the Safe Banking Act for cannabis companies not in there. And that is probably not going to happen during the next 2 years because Republicans don't like that. They'll control the House, so that could be off until 2025. But we don't have to worry about the government shutting down this year. Everybody can go home for Christmas and not worry about it.
All right, it's a holiday week, and we got some low volume in the markets, and we got to talk Trump, of course. The IRS's audits of Donald Trump's tax returns, they are delayed, and this is raising some serious concerns on how the former president has escaped scrutiny here once again.
Yeah, you know, the headlines on Trump are kind of falling lower on the front page these days, but this is fascinating. Congress has finally gotten 6 years worth of Trump's tax returns. They have not published the full returns yet, but they've published some summary information. It's enough to tell you that Trump's tax returns are a modern marvel. So what I've been able to tell from these returns is if you add up his income for those 6 years, he made $147 million in income from 2015 through the end of 2020. I mean, I would take it. But at the same time, Trump declared $221 million of losses. So if you net it all out for that 6-year period, he lost $52 million on net, or that adds up to about $8.2 million in losses per year. So is Trump actually losing $8.2 million per year? We won't know for sure until we see the full returns, but tax experts say absolutely not. This is Trump's time-tested practice of finding all kinds of business losses and other types of losses that he can use to offset his real income. And as a result, his tax payments are paltry. There are a couple of years, 1 year he paid nothing, a couple of years he paid only $750. And his total income tax payments at the federal level for that period of time were only about $1.5 million. So, you know, somehow Trump earns 9 figures over this period of time, and he only pays $1.6 million in taxes. We're going to soon find out a little bit more about how in the world he pulls that off.
Well, don't hate the player, hate the game. Close the loopholes, man. One of the biggest problems here is the IRS didn't properly audit him. Is that correct?
Right. So it is IRS policy, but it is not federal law to audit the president's taxes every year the president is in office. And it is now clear that the IRS did not complete an audit of Trump's taxes for any given year while he was president. Now, the obvious question is, did Trump lean on the IRS and make sure that didn't happen? That might be a good guess, and I think we'll learn more about that in coming weeks. And Dave, just before when you said, blame the game, not the player, that is a huge question here. So what we're going to learn more about is whether, people who own businesses are allowed to take business losses over the course of many years to offset their income. The question is, did Trump inflate or even invent business losses? In other words, cheat. And up till now, there has been substantial evidence that he certainly inflated losses and may have gone further than that. So we are soon going to get some answers to this question of, is Trump a tax cheat or is he just extremely clever?
Yes, and some answers that the American people desperately need if, in fact, he's going to run for president again. We hope, that we get answers, not the latter. We won't address that. Rick Newman, good to see you. Thank you.
Guys.
Coming up, sudden temperature drops, sub-zero conditions, and plenty of snow making its way across the U.S. We'll fill you in on what to expect over this Christmas weekend. Next. Welcome back to Yahoo Finance Live. The winter storm sweeping across the U.S. this week is intensifying into a bomb cyclone, bringing sudden temperature drops and freezing weather to the Midwest and Northeast. The Arctic blast has already brought sub-zero temps to cities like Denver and Minneapolis, while Chicago, Nashville, even Dallas will feel like below zero tomorrow, according to AccuWeather. The storm tackles the East Coast on Saturday. Areas as far south as Jacksonville, Florida will experience freezing temperatures, and it will also feel freezing in Washington, D.C. and here in New York City. But it's not just the cold you need to worry about. Parts of the Midwest and the entire Northeast will face wind gusts upwards of 40 miles per hour. NOAA adding that travelers need to be wary of snow squalls, flash freezing, and icy spots on the road. Stay home, work remote.
Oh ho, fledgling meteorologist here at Yahoo Finance. Very nice work, Dave. And by the way, this bad weather is certainly going to impact travel for the holidays this weekend. And we got to bring in our next guest, Haley Berg, lead economist at Hopper. Haley, what can you tell us about these winter disruptions that people may experience with respect to their travel plans?
We're already seeing the impact. Today and tomorrow, about 7 million Americans were supposed to take off for flights over Christmas weekend. We know that thousands have already been canceled or delayed, and we expect that to continue into the weekend. All in, we could see hundreds of thousands of passengers stranded or unable to make the trips that they planned for holidays after 2 years of COVID and being unable to travel.
Yeah, 2,500 flights already canceled, according to FlightAware. So what should people do? And is it too late, Haley, to get travel insurance now?
Depends on where you booked. If you booked on the Hopper app, for example, you can add a disruption protection product as long as your flight doesn't depart in the next 12 or 24 hours. So if you're leaving Saturday, Sunday, maybe on a vacation, you can add a disruption protection, but check what is already included in your ticket. If you booked through a credit card company, sometimes travel insurance and disruption can be included. So find out what's already available to you. But if you are leaving in the next 12, 24 hours, even 36 hours, download the airline app and set up alerts so that you're getting real-time information about what's going on with your trip.
All right, most people's 2022 plans probably in the bag here, but thinking ahead to the new year, what are some of the destinations that people are looking at here and abroad?
Mm-hmm. Well, one of the most interesting trends we're seeing in 2023 is an incredible surge in demand to Asia. We're seeing destinations like Ho Chi Minh City in Vietnam and Tokyo at the top of the list for the most searched for and the most booked destinations in the new year. Now, as airlines rebuild those trans-Pacific routes, which have been slower to recover than the domestic market, we're expecting to see even more volume of passengers headed to either Asian, Southeast Asian, and Oceanian destinations like Australia, Fiji, New Zealand.
Haley, recently we had kind of dueling CEOs talk about the demand they're seeing on the horizon, Delta versus JetBlue. What type of demand are you seeing into 2023?
All the signals we have now are that demand in 2023 will remain extremely strong. We did a survey recently of Hopper app users, which are primarily millennial and Gen Z, and over 95% of them are planning a trip in 2023. Over 80% plan to spend more or the same that they did this year on travel. It shows us a theme that has been persistent for the last 5 to 10 years, but even more so coming out of the pandemic. more Americans are spending on experiences, which involve travel, than they are in consumer goods. So we are expecting a strong year next year, hoping to see some lower airfares to make those summer vacations and those bigger trips more affordable.
Back to the present here, with people maybe getting trapped at airports over the next few days. What are some tips you might have for travelers who are a little bit bogged down by the weather?
Unfortunately, we can't control the weather, but you can be proactive. So even if you're not flying out of one of these airports who's going to be directly hit by snow, ice, and wind, you could still be impacted. So I'm talking to you in the Southwest and California. If you're able to drive safely to your destination, you may want to consider doing so, given all of the planes in the Midwest, Northeast are going to be really tied up for the next couple of days. For those who are about to endure probably some long lines and cancellations, pack your patience and go prepared to the airport. We are likely to see mass disruption. So, be ready for what's ahead.
Oh, goody. Flying with 3 kids on Sunday morning. That should be a hoot. Domestic locations that are hot in 23. What are they and why?
We're expecting to see continued demand for big cities. So Las Vegas, Orlando, Los Angeles are some of the top destinations we're seeing next year. Florida has been a huge winner in 2022. We expect to see that continue next year. It offers a lot of beach frontage, low prices, given so many low-cost carriers are flying in and out of different parts of Florida. So we expect to see that continue, as well as some of those outdoor cities like Denver and even parts of Montana with access to national parks. Our parks are really increasing in popularity.
Haley, we got time for one more here. I'll give you the floor. Anything that you found interesting this this season in your job that you haven't had a chance to share with us just yet?
I think we have talked a lot about demand and pricing, but remote work is a really interesting trend. So, about half of Hopper users have some level of remote work flexibility, and they say that going forward, that is going to impact how they plan travel, whether it be traveling midweek to take advantage of those low Wednesday and Thursday prices, or extending stays, turning a business trip into a vacation. I expect we're going to continue to see this blending of work and leisure to expand travel for many Americans. So I'm really looking forward to next year seeing how that shapes out, how travel is going to be different moving forward now that remote work seems to be a core part of how people work today.
Yeah, the bleisure trend. Big fan of that. Haley Berg, Hopper's lead economist. Merry Christmas to you. Thanks for being on. All right, time now for what we're watching tomorrow. I'll be watching new home sales. The expectation is for 600,000 new homes sold in November. That's lower than last month, 632,000, and far below the 756,000 sold a year ago. This comes today as new Redfin data shows November home sales fell 35.1% year over year, and new listings slumped 28.4% year over year. The real estate data has come fast and furious and has all been pointing to just an ugly housing sector as we close out 2022. Coming up, Twitter introduces a new feature for stock and crypto traders. We'll have more details on how it works and what users can expect next.
Welcome back. Twitter unveiling a new feature that makes it easier to check stock prices. Now you can search a hashtag that consists of a $ and the ticker symbol. You'll see the company's stock chart. Now the charts appear to be sourced from Robinhood, and Twitter says it will be expanding coverage so the feature covers more ticker symbols. And Dave, I got to tell you, this is a feature I've wanted this for years. I wish it pointed to Yahoo Finance or maybe had some native functionality in there, but it just highlights to me there's a billion opportunities with different directions that Twitter could go, and especially in FinTwit, tons of opportunities here. And yet, contrast that with some of my favorite Twitter followers and some of my not so favorite Twitter followers saying that the platform is coming to an end in the near future, acting like it's not even going to be here next year. I don't think it's going the way of the dodo bird just yet. I think there's a lot more tricks to be rolled out here, and I'm looking forward to them.
I think this is one of the few real positive innovations that Elon Musk has pulled off there. So you simple search with a cash tag, and then it's going to give you that. The one thing that's not going over well in the Twitter's verse, as I'm sure you've read, is that it takes you to Robinhood. Once you put in the cash tag, say TSLA with the $, it gives you that Robinhood setup. And if you want to go further, people on social media are furious about that. Now, that's primarily, of course, the meme stalkers who are still furious about what happened with GameStop when they when they turned off the buy tab, right? Yes. And just allowed the sell as GameStop was rocketing up. So a lot of people on social media right now are saying, no, I will not cooperate in this, and at least saying we'd like some transparency. What is the financial relationship between Twitter and Robinhood, which does seem like an easy thing for Elon Musk to clear up. Sure. Clearly, they must have paid for that benefit.
Or some kind of partnership. Could be quid pro quo, and it could be, I would assume it's on the up and up. No reason to think it shouldn't be.
No, but...
And like I said, no reason it couldn't be a host of companies, and there are a variety of options. Just in terms of building out the functionality, by the way, I think it was Howard Lindzen who invented cash tags about 10 years ago, and everybody had these wild dreams of what would be possible in Twitter, and nothing else really happened with them until they were officially supported by Jack Dorsey a couple of years later. But that's just supporting the tag, no functionality beyond that.
Yeah, it's positive movement for the financial news industry. Just have some transparency. He's got to make some money somewhere. All right, parents across the country are keeping a close eye on their finances as interest rates continue to climb. One area in particular, college savings plans, because you know the cost of college is skyrocketing. Two of the more popular ways to save are through 529 college savings plans and the Coverdell Education Savings Account. Our own Rhonda Lee joins us now to help break down these plans and how, most importantly, they differ. Rhonda, what do we need to know?
So for the Coverdell plans, the big, I want to say, reason for most people not to pick them. It's one, they have an age limit, 18 and under. Two, they have income requirements. So for the single filers, I believe it's 110. For joint filers, 220. The other thing is the maximum annual contribution is $2,000 a year. For this reason, most people are probably going to gear towards the 529 plans. With the 529 plans, no age limit, there is no income limit, and there is no annual contribution limit. That makes that the 529 plans much more attractive for most parents and grandparents looking to help save for college.
All right, and we understand that most parents opt for this 529 plan, but what are some of the options that parents have here?
So the first option is a prepaid tuition plan. And for this one, this can be offered by states and colleges. But this is kind of like assuming that your child is going to go to that institution. So if you are doing this prepaid tuition plan, this is the school your kid's going to end up going to. Also, with the prepaid plans, the money can only go towards tuition. Whereas the second option is a savings account that is similar to like a 401k, where you pick your investments, a mutual fund, or just like you have your target dates with your 401k, they have age-based ones. So if you know your child's going to graduate from high school, I'm picking a number, 2053, you pick that fund. So that fund is probably where most people want to go because it's going to be a little bit more flexible for them. Plus, it also gives you some flexibility. So if you move to a different state, you can have the fund move with you.
I got 3 kids to put through college. I'm taking notes. What are some of the major restrictions that come along with the 529 plans?
So with it, even though there's no annual limit on contributions, most states have an annual maximum that you can contribute. And that's somewhere, and it varies by state, usually somewhere between $250,000 to $500,000. So that's one of the things to know, that once you've hit the maximum for the state, you can't contribute anymore. The other thing is that you can change your investment plan strategy twice in a year. Also, again, as I said before, if you move to a different state, you're allowed to change plans once in a year. So those are the 3 major things to consider with the 529 plans.
All right. Well, thank you for all that useful information there. Dave taking notes as I'm watching him here, Rhonda Lee. All right, coming up, simply skiing the slopes may be a fun day for more people at a ski resort, but not the ultra rich. Find out what experience they're seeking up next. Welcome back. Before we go, we want to take another look at how the market ended today. And by the way, the Nasdaq, which has been the laggard all year long, that is the laggard today, down over 2%. The Dow down 1%, and the S&P 500 sandwiched in between. I want to go to a very long-term chart of the S&P 500. This is a 10-year chart. I'm going to throw some candlesticks on here. And I just want to point out that the price action we've been seeing over the last few days is highly reminiscent to me over what happened in December of 2018. And that was when we had an overly hawkish Fed, very different from the Fed we have today, different macro environment, but we saw a big slide into the Christmas holiday and then a huge rebound. The S&P 500 was up 5% the day after. So that would be the equivalent next Monday. No guarantee that's going to happen, but some interesting parallels there. So let me go to a year-to-date chart of the S&P 500, and we're still camped out fairly close to those lows that we had down in October. You take a look at the Nasdaq, and we are right down with those lows. Didn't make a new low of the year on the close just yet, but that's in contrast to the Dow. Dow in the middle of its range here and performing much better. We've been talking about the outperformance of value versus the cyclicals. Well, here's how we stand today in the in the sectors, but I want to check out what's happened this week. Healthcare's financial, energy is break even, but financials and healthcare, those are outperforming just barely in the green, but it's consumer discretionary. XLY has been taking it on the chin. It is the worst performer of the year, down 4% today, followed by tech, real estate, and communication services, and just no break, no respite for a lot of these big tickers that we like to look at, especially the mega caps. Tesla down 16% this week alone, Dave.
Just continues to take a beating. Tesla just stands out, down far more than the Nasdaq on the day. All right, many of you are headed for the slopes this week, but will you ski on fresh tracks, pink snow, or with an actual Olympic athlete? Those, according to a piece in the Washington Post, are a few perks paid for dearly by the top 1%. Fresh tracks, or early access as some call it, gives you the fresh snow everywhere you go, typically for a group of 10, for an hour, and prices widely range depending on the resort. At one fine stay, you can pay $1,700 for a half day or $2,800 to ski with an actual Olympic skier. Yes, others just can't stand waiting in lines, awkwardly shuffling their skis forward. But for $1,300 a day plus tip, lines do not exist to you nor your chairmates. Too tough to take pics, though, with those bulky gloves or mittens. You know, the selfies are really difficult. No worries. For the rich, $1,000 gets you a personal photographer, but not with the photo album. That cost an extra $1,000. One Aspen couple paid a staff member, Jared, to carry around their champagne on a snowmobile all day. That's spectacular. And Deer Valley might win the prize. One regular paying an undisclosed amount to have the snowmakers blow pink snow while he and his wife took a chairlift ride. So if you get one of those perks paid for by the top 1%, or something else entirely, if you were super wealthy, what would it be on the ski slopes?
Well, I got to tell you, I'm from Miami, didn't do a lot of skiing when I was a kid. Those lessons with an Olympic athlete would be a total waste on me. So I'm not going to go for that. I like the idea of a ski butler, because what can you do that what do you need skiing that a ski butler can't provide? Whether it's pink snow, because I think you could wrap some of these up into more than one, or even rose petals while you're skiing. I don't know.
Rose petals. I like that.
I know nothing about skiing. Is this possible? I don't know, but I'll just throw that out there.
Two of them I'm actually really interested in. The fresh tracks really appeals to the, I'm a hardcore skier, grew up at 3 years old on the slopes. There is nothing like skiing fresh snow. So that one I get. Pink snow, champagne, all that I don't understand. And the photographer, love taking pictures when I'm with my family, and taking those selfies is really difficult when you're in all that ski gear, gloves, your hands are freezing. So those two I would pay for. But Jared, my favorite part of skiing is lunch. And when you go into lunch, it is packed and you're looking for 2 or 3 seats and the whole crowded cafeteria. I would more than anything pay for a nice private area, comfy couch to have my beer and have my chili and be comfortable, because I like a nice long skiing lunch. That would be worth a few extra bucks to me.
I could get into that. I really could. I want to know who's in charge of retrieving all those cell phones from the failed selfie pictures on the ski slopes. There's got to be somebody doing that, right?
I'm sure that's a full-time job.
All right, that's going to do it for today. Yahoo Finance Live. We're going to be here tomorrow, so come back at 3 p.m. Eastern for all of our coverage leading up to and after the closing bell.